Forex. You know, it's this wild world of flashing numbers and intense financial jargon that can just seem like a completely chaotic blur from the outside looking in. But hey, welcome to this explainer. Today we're cutting right through all that noise. Our goal here is to break down the incredibly fast-paced machinery of foreign exchange trading into a clear, completely actionable blueprint. No impossible promises, no fluff, just the exact grounded mechanics of how this market actually works. And when I say machinery, I mean a complete and absolute behemoth. Trillions, literally trillions of dollars. That is the staggering daily volume of the global Forex market. Just to put that into perspective for a second, Forex processes more capital in just a few days than the entire global stock market does in a whole month. It never sleeps, it's constantly running 24 hours a day, 5 days a week. But what is it actually doing with all that money? Well, at its absolute core, Forex is simply exchanging one country's currency for another. And this massive volume isn't just everyday retail traders sitting at home. Those trillions are being moved by central banks, major governments, massive multinational corporations who are hedging their international costs, and heavy-hitting institutional investors. Okay, let's dive into this with a really structured 5-step roadmap to take you from absolute zero to a functional, solid understanding. We're going to cover 1. The world of Forex, 2. The language of trading, 3. Making sense of price, 4. Mastering risk management, and 5. The beginner's roadmap. Step 1. The world of Forex. Let's start with the absolute foundational rule of the market. Currencies are never, ever traded alone. They are always traded in pairs. Take the EUR/USD, for example, which is the most traded pair globally. A price of 1.1000 simply means 1 euro equals 1.10 US dollars. Now, just follow the math here. If that price ticks up to 1.1100, well, it now takes more dollars to buy a single euro. Therefore, the euro just got stronger. It's as simple as that. Moving right along to step 2, the language of trading. So the financial industry absolutely loves intimidating jargon, right? Let's just crush some of those terms down into everyday language, starting with the pip. Standing for percentage in point, it's basically the smallest movement a price can make. If that euro/USD pair we just talked about moves from 1.1000 to 1.1001, that tiny microscopic shift of 1/10,000th, that is exactly 1 pip. It's the universal yardstick we use for measuring profit, loss, and your costs. Let's move to and see how this builds right into our next term, the spread. This is simply the gap between the buy price and the sell price at any given millisecond. Say you want to buy at 1.1002, but the market will only let you sell at 1.1000. That 2 pip difference? That's the spread. It's essentially the transaction fee for opening your trade, and it is exactly how your broker makes their money. Next up is leverage, and wow, this is where things get fascinating and honestly highly dangerous. Leverage is borrowed trading power. It lets you control a massive market position using just a tiny fraction of your own actual capital. So a 1 to 100 leverage ratio means that with just $100 out of your pocket, you are controlling a $10,000 footprint in the market. It's the exact kind of multiplier effect that famously allowed traders like George Soros to make $1 billion in a single day. And this brilliantly illustrates the ultimate double-edged sword of finance. On the good side, your profits are calculated on that full $10,000 position, which completely amplifies your returns from tiny little price moves. But the bad side? Yeah, your losses are amplified in exactly the same way. A fractional move against you can instantly, and I mean literally instantly, vaporize your initial $100 deposit. This mechanic right here is exactly why beginners blow up their accounts so incredibly fast. Step 3, making sense of price. So how do traders actually make sense of all these flashing numbers and decide what to do? Well, they generally rely on a 3-part analytical toolbox. First, technical analysis. This is studying the charts, using historical patterns to try and predict future moves. Then there's fundamental analysis, which looks at the real world, stuff like interest rates, employment data, and major geopolitical news. And finally, sentiment analysis. This one is all about reading the room. Is the market currently being driven by fear or greed? Now, if you're leaning into technical analysis, you're going to be reading what we call candlesticks. A bullish candle simply means the price closed higher than it opened. The buyers grabbed the wheel and drove the market up. A bearish candle means it closed lower. The sellers pushed it down. By just glancing at the color and the shape of these candles, you can instantly gauge who currently has control of the market momentum. Watch how all this vocabulary we just learned comes together to form a classic buy setup. First, you spot a general uptrend in the market. You wait patiently for the price to dip down to a support level, which is like a historical floor. Right at that floor, a bullish candle appears, signaling that buyers are stepping back in. Boom, you execute your buy order. But crucially, you immediately place a stop loss just below that floor to automatically cut your losses if the market suddenly turns against you. Which leads us perfectly into step 4, mastering risk management. That concept of the stop loss, that brings us to the absolute climax of this whole explainer. I need to get serious for a second, because professional trading is entirely about survival, not just profit. Here is your shield. Never, ever risk more than 1 to 2% of your account per trade. Always use a stop loss. Period. No exceptions. Use take profit orders to secure your wins automatically. Do not overtrade. And you must fiercely control your emotions. Without these rules protecting your capital, you literally won't survive to trade tomorrow. Now, what's really interesting about this slide is how the math of failure in Forex is highly, highly predictable. Bad habits map directly to disastrous outcomes. Trading with no strategy, that leads straight to random, chaotic trades. Using over-leverage, catastrophic, huge losses. And trading without a stop-loss almost guarantees a blown account. Look, 90% of beginners lose money purely because they ignore this basic cause and effect. Finally, step 5, the beginner's roadmap. All right, it's time for a massive reality check here to completely destroy those toxic get-rich-quick myths being peddled by fake influencers on social media. Making 3 to 10% monthly on a consistent basis is considered absolutely phenomenal in the professional trading world. The fantasy of turning $100 into $1 million overnight, that is specifically designed to take your money. Real trading is all about controlled compounding growth over a long horizon. So the crucial point is that it all boils down to a very stark choice. Forex is straight up gambling when you rely on gut feelings, ignore risk management, and let your emotions drive your clicks. But it becomes a profession when you follow a strict rule set, mathematically cap your downsides, rely on statistical probabilities, and maintain absolute iron discipline whether you happen to win or lose that day. If you want to take the professional route, follow this highly practical blueprint. First, start with the absolute basics. Understand pips, lots, candles. Then, move on to technical analysis, studying market structure. Master the math of risk management. Then, and this is vital, spend months, not days, months practicing on a demo account with fake money. Only after you've proven you can do that do you open a real account, trading with tiny capital just to test your real-world emotional control. Which leaves us with the ultimate question for you to ponder. Are you here to gamble, or are you genuinely ready to learn the skill? Because Forex is not a lottery ticket, guys. It is a high-performance discipline demanding respect and patience. The market isn't going anywhere. It'll be there tomorrow. The real question is, will you be truly prepared when you finally step into the arena?